Tesla stock is trading at exactly $380.42, down 2.61% in recent trading activity as the market digests the heavy implications of the upcoming July 22nd second quarter earnings report. While the broad market expects this price compression to be a sign of simple pre-earnings anxiety, the underlying reality is far more complex and unexpected. Institutional capital is quietly moving behind the scenes, shifting focus away from vehicle volume and placing massive bets on a sudden structural realignment in energy margins and artificial intelligence capabilities. Most retail traders are watching the charts, waiting for a breakout, but smart wealth managers utilizing advanced platforms like Schwab Intelligent Portfolios or traditional self-investing setups are looking at something entirely different. They are evaluating a profound shift in capital allocation, where Tesla is no longer priced as an automotive producer, but rather as an industrial energy and automation conglomerate. The general market sentiment right now tells a simple story, suggesting that because Tesla managed to beat delivery estimates with 480,126 units in the second quarter, the stock should be positioned for a straightforward post-earnings rally. This expectation creates a classic trap for standard online investment strategies that rely solely on surface headlines. The contrarian reality is that those massive delivery numbers were heavily propped up by aggressive promotional pricing and financing incentives, which are highly likely to compress automotive gross margins to uncomfortable levels. When you look at platforms dedicated to online investing, you see a massive division between the traders seeking quick investment help and institutional players executing precise strategies within an individual brokerage. Traders using a modern individual brokerage or traditional institutional services are grappling with the fact that Tesla has drifted below its key 50-day and 100-day exponential moving averages, highlighting a clear lack of short-term technical support despite record-breaking unit volume. This technical weakness is creating significant friction across major online spaces where retail capital gathers. On major platforms like Fidelity, users managing diverse portfolios via Fidelity Investments, Fidelity ETFs, or Fidelity Mutual Funds are actively debating whether to hold the line or trim exposure. The data inside a standard Fidelity brokerage or Fidelity wealth management account often mirrors a long-term retirement approach, which is why inflows into Fidelity IRAs for mega-cap tech remain steady. Yet the price action on the Fidelity mobile app and the main Fidelity trading platform shows real-time hesitation. The intraday volume of 31.39 million shares sits just below the historical average of 34.64 million shares, proving that large institutional players are keeping their powder dry until the formal financial statements drop. The premium pricing of the options market is currently implying a massive 7.6% price swing immediately following the Wednesday afternoon announcement, showing that uncertainty is exceptionally high. Over on Robinhood, a completely different psychological dynamic is playing out. Younger retail investors utilizing Robinhood stock trading and the main Robinhood app are treating the current drop below the $400 mark as a prime accumulation window. The continuous inflows through Robinhood investments alongside capital parked in Robinhood cash management accounts suggests a high risk tolerance that thrives on single-name volatility. Many of these retail buyers rely heavily on Robinhood fractional shares to build positions in high-priced assets, ignoring the macroeconomic warming signs that traditional wealth managers obsess over. At the same time, the broader interest in Robinhood crypto indicates that the demographic trading here is highly speculative, looking past near-term auto margin compression to focus entirely on the long-term potential of the autonomous cybercab and decentralized AI networks. A similar story of strategic fragmentation appears when looking at alternative digital wealth platforms. On SoFi, users engaging with SoFi Invest and general SoFi investing trends are trying to balance the risk. The platform shows steady accumulation of diversified tech holdings, with retail traders split between automated SoFi robo-advisor allocations and hands-on choices in SoFi active investing portfolios. The discussion threads within the SoFi trading platform point to a major underlying question. Can the unprecedented 13.5 gigawatt-hours of energy storage deployment offset the margin damage done by slashing car prices in China and Europe? For those using comprehensive, professional-grade systems like interactive brokers, the focus is entirely structural. Professional traders analyzing capital flows via interactive brokers' trading software are dissecting the exact fee structures and account balances required to hedge this upcoming 7.6% options implied move. The interactive brokers platform highlights that short interest has stabilized, but institutional long positions are using sophisticated derivative collars to protect their downside capital, recognizing that a break below the crucial $369 support level could quickly open the door to a sharper drop towards $355. Comment below how many shares of Tesla stock you currently hold in your portfolio and what your average cost basis is before this upcoming earnings report drops. To understand how this massive gap between expectation and reality formed, we have to look closely at the operational foundation of the company. Tesla operates a deeply integrated business model that spans premium electric vehicle manufacturing, commercial and residential solar installation, large-scale battery energy storage systems, and advanced autonomous driving software. Over the past few fiscal quarters, the core automotive segment has faced intense global headwinds, particularly from domestic manufacturing giants in China that are producing low-cost electric vehicles at a scale that challenges Western pricing structures. In response, Tesla utilized its robust balance sheet to absorb margin hits, offering cut-rate financing terms and direct price reductions to clear accumulating factory inventory. While this corporate decision successfully protected their title as a top global EV producer, it drastically altered the financial profile that traditional analysts use to justify a high earnings multiple. The historical data highlights that this is not the first time the company has hit a structural crossroads. Looking back over the trailing 12 months, the stock has traded in a wide, volatile corridor between $297 and $498. The current quote of $380 represents a substantial 24% retreat from those late 2025 peaks, leaving the stock effectively flat over a multi-month view as investors demanding clear earnings quality wrestle with those who prioritize raw volume expansion. In past reports, particularly the first quarter update earlier this year, the company reported better-than-expected bottom-line earnings but missed on top-line revenue, which immediately prompted management to raise capital expenditure guidance to an annual rate exceeding $25 billion. That capital is flowing directly into massive compute clusters, humanoid robotic development, and factory infrastructure necessary to scale next-generation vehicle architectures. This aggressive internal spending keeps the forward price-to-earnings ratio pinned at a demanding 349 times earnings, leaving absolutely no room for operational errors. Looking out at the immediate future, the core investment thesis is split into two distinct paths, both entirely dependent on whether expectation can catch up to reality. In the bullish scenario, the upcoming earnings report surprises the market by showing that the energy storage business, which commands significantly higher gross margins near 29%, has grown rapidly enough to completely cushion the blow of lower automotive profits. If management can couple a margin stabilization report with a highly detailed, concrete production schedule for the autonomous cybercab, institutional capital will likely flood back into the asset, driving a rapid technical breakout past the $386 resistance line and retargeting the long-term moving average cluster near $400. This outcome would validate the decisions of long-term investors utilizing self-investing strategies on premium investing sites, proving that patience pays off when a company successfully transitions its product mix. Conversely, the bearish reality cannot be overlooked. If the automotive gross margin drops below the critical 17% threshold due to the international price cuts, the record delivery numbers will be viewed as a negative signal, showing that the company must actively sacrifice its financial health to sustain unit demand. A disappointing call lacking clear updates on autonomous regulatory approvals or presenting further delays in the development of low-cost next-generation models would likely trigger a severe institutional liquidation. Under these conditions, short-term momentum traders on retail applications would face heavy losses as the price violates the structural support levels established earlier in the summer, potentially resetting the baseline value back to the mid-300s. Navigating a stock this volatile requires an objective understanding of the deep contrast between the popular public narrative and raw financial metrics. The broad public expectation is focused squarely on delivery milestones and the conceptual promise of autonomous transport fleets. The hard reality is found in the compressed automotive margins, the rising capital expenditures, and the technical resistance lines currently dominating the charts. As the market